And of course, we have had lots of interest rate hikes, and so one question that we often have to think about is which financial bubbles should burst with higher interest rates. Often you do get decoupling between the real economy and the financial markets. And so is there something in the financial markets that should blow up at these levels of interest rates? We have seen obviously some turmoil in regional banks. Obviously last year, equity markets sort of fell, bounced back since then. Are there certain pockets of the financial markets you think are particularly vulnerable to higher interest rates?
I mean, the big picture story that we have to recognize is that the real economy and even the financial economy is a lot more insulated to interest rate moves than where we were in previous cycles. And I think, for those of us who were trading markets back before 2008 and really understood how the composition and the structure of the financial economy back then, I think most people who knew and understood how the pipes work back then versus understanding how the pipes work today and the economic condition of the financial intermediaries, what you'd say is, wow, things have changed a lot, right? Like in 2008, banks were capitalized, had 3% capitalization rates. Today it's 15. I mean, wow, that is a big difference. You know what I mean? Like that is a radical difference in terms of the most highly levered entities in the markets. In fact, when you look at the problem that we experienced, right, with the regional banks, what was the problem that we experienced? Well, I mean, there was duration issues, right? They had too much duration risk, which created a mark-to-market issue, which created a bank run. Okay, well, that is, no banks can withstand bank runs, but the interesting thing is that mark-to-market risk, it really wasn't that bad because the bonds that they were holding were money good at par, right? And of course, if you mark to market those bonds in an immediate sense, you create that imbalance between the value of the deposits and the value of the assets. But if those bonds were held to maturity, most likely the lifetime cost of the deposits would have been considerably lower than even the low yield on the bonds, which would have led to the fact that the banks, might kind of stink as a business, might be kind of not particularly profitable. But it doesn't mean that they were likely to fail. And so the Fed mostly has resolved that situation, right, by providing unlimited liquidity at par against those instruments until the point in which they mature, at par. And so, that core issue is basically behind us. And so now taking a step back, scan the lens of the universe of creditors, right? Leveraged creditors are what create self-reinforcing downward dynamics in financial markets. The banks are not big leveraged creditors. They're much more insulated and well-regulated. The insurance companies, which we don't have time to go into all the details, are very well matched and very well managed as a function of the lessons learned in 2008. Those are typically the big, in 2008, those were the big entities that caused all the problems, right? The banks were broke and the insurance companies were broke. Today, a lot of the credit cycle, a lot of the credit dynamic has moved into things like private credit and vehicles like that. And a lot of those vehicles, maybe they have one turn of leverage, right? They're 50% debt, 50% effective equity from the strategic allocators that are giving the money, the unleveraged strategic allocators that are giving the money, but they're not, one turn of leverage. Like, who cares? Or even the CRE stuff, people look at it, they're like, well, CRE prices are going to go down. Yeah, but the LTVs are 50%. Like, we can deal with that problem. That I wouldn't want to be an equity holder in that, right? Like, that will suck. But if you have 50% LTVs, like, how bad can it really be? Even at cap rates that we're likely to see, reset cap rates we're likely to see, like, it's just the whole system is just a lot less leverage to the interest rate dynamic than we were 10 or 15 years ago.